Hello and welcome to a special presentation here in mid-April of 2022 by Advanced Projections. And we're going to address the question, is a recession coming? And this is going to be based upon our 6 indicators. So we have developed a family of 6 recession indicators based on things which are generally known about the economy and specifically on data from the last 50 years. So we're going to look at those indicators and what's in the data right now. First, one little bit of education here. There's a common misconception that the US Treasury prints money to supplement government spending needs as dictated by Congress. When the government typically overspends, spends in deficit, people think that, well, it's the Treasury that prints the money. Actually, the Federal Reserve is the only source of money supply growth or contraction. The Treasury basically has to either fund its requirements by taxation or by borrowing. And that's all they do, tax or borrow. Okay, here's our 6 indicators, which we developed based on about 45 years worth of data when we first came up with them. Now we're well into 50 years of actual data and use. They are an indicator based on the money supply, an indicator based on the yield curve, which is the basic characteristics of interest rates from very short term to very long term. There's a Federal Reserve indicator, which is based upon the stability of the overall financial and banking systems. Leading economic index indicator, stock index indicators, what's going on in the equities markets, and a precious metals indicator, which is based upon gold and rhodium. All right, so what we're going to look at is each of these indicators and what they've done since about the year 2000, just before 2000. And these gray areas that you see here are the last 3 recessions. This was the dot-com bubble recession. This was the Great Recession, and this was the recession which was characterized by COVID, but we kind of knew it was coming before COVID was ever talked about. All right, so this is the leading economic indicators, and we look at 2 different baskets of indicators. They come in with analog values, and we compare those to specific limit tests, and as those indicators start dipping, we get a yellow warning and then a red warning, and the red precedes the recession. Typically, when you get out of the recession, the leading indicators still have to recover. So you'll see, again, here ahead of the Great Recession, leading indicators took a dive, and the recession itself, they really got hammered that time and came back. By the end of the recession, they were looking pretty good again. Up ahead of recession 2020, they took a very fast dive. This is basically because of what happened when COVID started to appear on the horizon. And they took a hard dive, but the massive federal response basically made those turn around pretty quickly. The yield curve. Yield curve is based on interest rates for about 10 or so time periods that the Treasury updates daily. There's a Fed funds rate, which more or less represents the 30-day yield. So you have 30 days, 60 days, 6 months, 3 months, 6 months, 1 year, 2 year, 5 year, 7 year, 10 year, 20 year, and 30-year yields. We look at 2 specific time periods. We look at the 3-month and the 10-year Treasury yields and compare those. When the 3-month exceeds the 10-year or gets close to it, this is when our yield curve indicator goes off. So in this case, the green areas, the 10-year yield is higher than the 3-month yield. When the 3-month yield starts to approach the 10-year yield and finally surpasses it, we get these red warnings. And these, again, come ahead of the actual recessions. So you see, the yield curve was already indicating we had problems. Nobody even heard of COVID back here in 2019, but the yield curve was already moving in the direction that basically foretold that there was going to be a recession. Now, this is one indicator out of our 6, which is absolutely reliable. All 7 recessions were preceded by this particular inversion on the yield curve. The money supply indicator is what we mentioned at the beginning of the talk here, that the Federal Reserve controls the money supply. This is the M2 money supply. And when the Fed works on contracting it, and it grows to, it basically slows down the growth, we get yellow or red warnings, depending on how severely they're contracting the money supply. Now, the money supply grew incredibly. This was the massive federal response to COVID. We dumped a lot of money into the economy in order to keep it afloat. It continued through the end of the pandemic, basically the worst of it anyway. And then the growth was started to be slowed down back to normal levels. First, this is normal level of growth, about 2%, 3% growth. Now it is being actually contracted. In the last 2 months, the Federal Reserve has shrunk the money supply a little bit, but it's going to accelerate quite rapidly in the next few weeks to $100 billion a month smaller in the money supply. The precious metal indicator, we compare the values of gold and rhodium, and the number, is a little less than 3. When rhodium outpaces the price of gold per ounce by a factor of 3, we get a red warning. When it gets into a zone, in anywhere from 2 to this number 2.7 or so, we get a yellow warning. So this is 3 or greater. This is less than 2. And sometimes gold is actually more valuable than rhodium. In these green periods, you saw that the price of rhodium would actually be under the price of gold. Somewhere in here is actually a really good place to invest in rhodium, by the way. And rhodium now is 10 times the price of gold. Gold is hovering just under $2,000 an ounce, and it jacked itself up into the several $1,000 an ounce period way back here in 2018. Again, ahead of this recession, before COVID was ever spoken of, this appeared to be red again. It's still red. We're still at almost 10 times the price of gold at this point. So this one looks like it's going to be hanging out here in the red zone for quite a while. This is one of our more complex indicators. It's very noisy because it's based on the emotions and volatility of the stock market. We look at the S&P 500 as being representative of the greater portion of the equities markets. And we have 2 portions to this indicator. One is market risk, which means when the S&P index is traveling on a growth curve, which is more or less normal. We're in the green. When it starts to get a little too warm, getting ahead of itself, we get these yellow warnings. And then when it finally just gets into the bubble zone, we get a red indicator. And we have specific growth curves which have been working again for 50 years, very clearly define, market bubbles. There was a bubble that, it collapsed. The dot-com bubble was here, it collapsed, and it came roaring right back a couple years later, ahead of the Great Recession. Even though that particular bubble was in real estate, there was a companion bubble in the equities markets. Market movement is when it'll be green when the stock markets are behaving within a normal bound of volatility. And if there is a price decline that exists about 4 months after a particular price level is set, this sort of filters out, the 1 month, 2 month, 3 month noisy volatility. But if a decline lasts longer than 4 months, we get a red indicator. Okay. So this is where some of the noise comes in. But you'll also see now we have periods where there's double red indication. All right. So we got double red here ahead of the COVID recession. We have double red here ahead of the Great Recession. We have double red here ahead of the dot-com bubble recession. Guess where we're at right now? Double red again. Stock indices are still in bubble territory, and they have declined for a period of more than 4 months. Okay, now let's look at the last two here. We have the Federal Reserve indicator, which is our stability indicator. The Fed basically does these calculations weekly and updates them. It's an analog value again, but we compare it against particular trigger points. And we have, these red indications back historically. We had one again ahead of the COVID recession. And now we actually fine-tuned our process a little bit on this. So now we have a yellow indication, and this is most likely going to be pretty noisy over the next couple of months because of what the Fed's doing and how the markets are going to respond. So those are our 6 indicators. In the news ahead, we have, what happened this month, the latest large dips in unemployment due to significant workforce and employment expansions. Unemployment's down to 3.6%. This is in historically low territory. It's not the absolute lowest we've ever experienced, but it's darn close. Our target for this year is actually down in the 3.3 to 3.5% as a bottom in unemployment. And you'll see on the next rather complex graph why those bottoms are important. This ultra low unemployment level gives the Federal Reserve a free hand to focus solely on their second mandate, which is stable pricing. Their first mandate is full employment, as full as they can get, which is, for their purposes, 4% or below is truly full employment. So once you're well below 4%, like we are now, they're going to ignore employment and focus on their other mandate, which is stable pricing. Stable pricing means we don't have price growth as rampant as we have right now, which is 8.5%. They want to see stable pricing around 2%. 1.5% to 2% is ideal inflation as far as the Fed's concerned. So they've recently begun to raise interest rates and reduce the money supply to bring inflation down, but they're going to be acting much more aggressively very soon because inflation is still hot. It had went from 7.9% to 8.5% in just the last month. Now, long-term inflation concerns are still not yet reflected in the prices of precious metals, which normally accelerate upwards rapidly if a lot of smart money is concerned about prospects of long-term inflation. So what you would see For example, if inflation starts hitting the precious metals market, you would see gold pushing from just below $2,000 now towards $3,000. You would see silver, which is in the mid-20s right now, pushing towards $35, $40 an ounce. And probably rhodium would make a run at its all-time highs. It's around $18,000 an ounce now. Its all-time highs were $25,000 set last year. And it could go higher, could push as high as 30,000. One of the reasons for that is Russia controls the supply of rhodium. And right now, of course, we have this issue with Russia and Putin and sanctions and so forth. And one of the things they could do is cut back quite a bit on the supply of rhodium, which is only about 100 tons a year of new material anyway. All right, now the final point here, there are portions of the yield curve that have already inverted temporarily, such as the shorter term 3-year versus the longer term 30-year yields on the 5th of this month, but not our specific comparison, which is 3-month versus 10 years, which is the most accurate of the yield curve inversions. So here's a simple verification of the success of our indicators. This is 50 years worth of employment data and labor force participation, along with the Great Recessions again. Now you see what happens ahead of each of these recessions as you see this hook down by each of the bottoms that are formed in the employment level, and they bottom out ahead of the actual recession. So what you'll see is our recession indicators. Here's a kind of a strip chart of all 6 of our indicators over 50 years. These black areas are, again, the recessions. These are our warnings. When we get to the 80% level, our warnings go off. And you'll see that when you see very low unemployment, coupled with our warning, a recession is pretty much guaranteed. All right, we're not into our warning stage yet because we're only at 50% this month, but it's likely to increase in the coming few months due to more aggressive action by the Federal Reserve. So this is what we're going to keep an eye on. We're already at, again, these very low unemployment numbers, and we're starting to ramp up our recession probability based on the status of our indicators. Okay, that's where we're at. We appreciate your time, and thanks for listening. Again, one thing here, bull markets, born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Well, we've been through the optimism, and we're still struggling with the latter stages of euphoria because the markets really haven't come down out of their bubble territory yet. But the party basically is over. People are being pushed out the door or leaving voluntarily, and that's what's happening with the stock market indices. So thank you again. Please consider giving this video a thumbs up. Subscribe to our AP Newsroom YouTube channel. You can get limited time free access to the full member reports via the first link in the description below. You could join our economy monitoring group on Facebook, which the link is also provided. And please give us a comment with your thoughts, questions, or suggestions. We starve for feedback. We would love to hear from you. Thanks again.